Hello, everyone. This is Logan Hertz with Hazeltine LLC. Today we have with us Terry Frazier, who runs the First Lien HELOC program at University Bank. He has over 20 years of experience in the construction, real estate, and finance industry, and we're excited to have him with us today to learn more about this First Lien HELOC program and the velocity banking strategy that goes with it, how it can be a much more efficient way to purchase, refinance, and strategically pay down really any piece of real estate. So Terry, good to have you on the program. How you doing?
Yeah, thanks for having me. Love it. Yeah, glad to be here.
So I always like to start with why. How did you kind of get introduced to the First Lien HELOC and why do you believe in it?
Well, it's a personal story for me. I've been using a first lien HELOC program personally to build a real estate portfolio. I've had over 60 units in my portfolio, and it's just been a nothing but a great success story, right? I was introduced to it through a company called Replace Your Mortgage about 10 years ago, and they taught me the education, and I really grasped it and started utilizing it, and honestly just kind of became an expert in the field through like osmosis of doing it, right? Like I've duplicated this process, I mean, countless number of times, whether it's buying properties, flipping properties, holding long-term rentals, doing VRBOs, and in my success run I gravitated towards the educational side and the finance side. So that's really what I do full time. I've been doing that a long time. I run the first lien HELOC division for the bank, and my job is to educate the certain group of consumers this works for, how the strategy works and the fundamentals behind it. And then in addition to that, just simply the math behind it, to be frank, and then teach them how it works, and help them get their portfolio of properties converted from traditional financing mechanisms to a first lien HELOC program.
Yeah, yeah. So with that said, do you want to maybe explain to us, for those who may not know, or maybe those who would like to deepen their understanding, what is a first lien HELOC? Why would anyone use this strategy and how does it work? Like, what's the advantage over a conventional mortgage?
Yeah, sure. Let me share my screen. I have an educational slideshow that I use to explain the strategy. It will help kind of cement the difference between a first lien HELOC and a uh, traditional mortgage financing, right? So you should be able to see my screen now, correct?
Yep, go
All
ahead.
right, perfect. All right, I'm going to slide you away. Okay, so this program and the first lien HELOC is opposite of what people do now. So the normal banking person operates in what's called traditional banking. And what that means is their checking account, their savings account, their mortgage account, those are all separated accounts. They're segregated. And this strategy is going to teach you that just mathematically, for the right person, there's a much better way to do it. So I start out by talking about biggest cities and biggest venues, right? Any big city you travel to, I don't care which one it is, whose name's plastered on every big building? A bank, right? It costs us literally millions of dollars to put our names there. And to be honest with you, the amortizing mortgage, and traditionally that's a 30-year mortgage, that's what puts our names on those buildings. That long-term amortizing mortgage is the most profitable product we have in our portfolio, hands down, no questions asked. And it's because of the amortization schedule, right? On how much money we make during the course of that loan, but more specifically, what part of the loan we make it in, which is the front side. Now, the goal for what I'm going to show you is that there is a way better way to borrow money for a certain group of people. And there's like no get rich quick scheme. There's no magic. There's no fees. There's no subscriptions. You don't have to buy anything. It's just using a simple interest loan in lieu of an amortizing mortgage to help secure the financing and payoff of a property. And I say this slogan all the time: it's math, not magic. There's nothing magical about what we do. It comes down to a simple math equation. 1 + 1 = 2, and 2 - 1 = 1, right? And this just comes down to a mathematical equation on whether this strategy works independently for you and for your situation. Math will give us the answer. It's an emotionless decision. A little history on mortgages, where they came from, is the Feds were established in 1913. The Federal Reserve was, and their main goal was to segregate you from your money. In doing that, they created a mortgage product, and in banks, we're always after your money, right? Open up a checking account, open up a savings account, bring us your money. Do you know why we want your money? Well, most of the time, people think it's because we make money on it, right? And that's part of the equation, absolutely. And you give us money, and rates are a little unique right now with what banks are giving out because short-term indexes have gotten high. So banks are increasing that. But in the normal world, the amount of money you get, 1/4%, 0.5%, 1% if you're lucky to throw some cash in a bank, right? And then we turn around and we loan it out at 5, 6, 7, 8%, whatever we can get for it. Well, that's a great business plan, like to start out with, but that's not really what we're after. See, banks, we do have a magic trick, and basically it's called fractional lending. For every dollar we take on deposit, we can loan out 10. So, Logan, if you give me $1, I can loan someone 10. You give me 10, I can loan them 100. You give me 100, I can loan them 1,000. We're allowed to loan through the feds 10 times what we have on deposits. And now that depository money is not what you put in the bank, it's what you leave in the bank. So if you deposited, 15,000 throughout the month, but you take out 10, your fractional lending money to the bank is not the 15 you put in, it's the 5 you left. So knowing that, banks had to figure out, how can we get people to put money in the bank and leave it? And they did it through a mortgage product. That they were completely successful. If you're a history buff, there's a book called Jekyll that talks all about this. It's crazy. It's almost like they predicted the future because the things they talk about are happening right now in front of our eyes. But the goal was for them to separate people from their money, and they did it with that 30-year mortgage because that's the most commonly used financial product in this country, right? And it's a one-way mortgage trade, right? When you put money into your mortgage, it's gone forever. You can't have it back. So banks that are servicing mortgages have this infinite amount of fractional lending dollars to loan to the feds. This is literally how banks got wealthy and stay wealthy, is this product. Now, the three variables to a mortgage, and really this is any loan, to be honest with you, is you have an interest rate, you have a payoff term, and you have a principal balance. When you combine those three things, you have a loan product of some sort, right? When you put those things in a financial product, you've got a loan of some kind. Now, the traditional mortgage, which is what most everyone watching this probably uses, it forces you as the borrower to make a monthly payment on the first of every month. And that monthly payment is no longer available to you to withdraw at any time. So banks that are servicing mortgages, we have this infinite pot of money coming in, right? So think about it. I'm not going to talk about escrows in this conversation because an escrow account, all that really is setting aside money for taxes and insurance. And that those fees are due whether you own the property outright, you have a HELOC, you have a mortgage. I'm not going to talk about that. I'm specifically going to talk about the principal and interest portions of the money. But your principal balance is deducted your balance is deducted by the principal amount of your payment every month. No question. There is net worth gain in a 30-year mortgage. I wouldn't even argue that, because you should have what's called property appreciation. And what I mean by that is next month your property should be worth slightly more than it is this month. So value higher, and you're actually going to owe a little less because the principal part of your payment is deducted from what you owe, right? So next month it's worth a little more, you owe a little less, your net worth went up. But specifically, the amortized interest that goes to the bank's bottom line is not a fair proportion. And it's very specific in the front end of the mortgage, right? Banks are front load these long-term mortgages with interest. So you're paying the biggest bulk of your interest in the first part of the mortgage. Now, who's kept a mortgage longer than 7 years? Hardly anybody. Everybody watching this, I'd say that about 98 out of 100 of you are going to say, no, haven't done it. Because statistically, 98 out of 100 people do not make the 84th payment on a mortgage. Now, it would be fabulous if 98 out of 100 people were paying their house off, but that's not at all what that statistic represents. It comes from, people selling their house and buying a new one. And when you do that, you start over and rates got better and you refinance, or you put a pool in or needed money for some reason and you refinance and access the equity in the property, right? So the mortgage process in a 30-year mortgage is basically duplicated. It's redone every 7 years, 98% of them. Now, this interest rate says 4%, right? And my question here is what percentage of your total of payments in the first 7 years is interest versus that goes to the bank versus your principal part, right? And let's assume in that scenario your rate's 4%. Well, you couldn't get a mortgage at 4% right now this minute because everything went wild over the past 24 months. It's working its way back down and rates are coming back down. They're going to get back into fours like they belong for sure. It's on its way there. But specifically in this scenario, let's assume that you could get it at 4%, right? What percentage of the amount of money that you give the bank in the first 7 years as interest with an interest rate of 4%? A lot of people think it's 4%, and that's not true. Through the amortization schedule, if you had a $700,000 mortgage at 4%, your principal and interest payment would be $3,341. That means in the first 84 months, you'll pay the bank $280,720. $183,000 through the amortization schedule goes to interest, 97 goes to principal. So that literally means 65.23% of the money you give the bank in the first 7 years is classified as interest, not principal. So there's two things in a mortgage. You have an interest rate, and then you have an effective rate of interest. And even though the interest rate, no arguing, is 4% on this loan, in this window of 7 years, the effective rate of interest is 65%, because literally 65% of what you give the bank in this window goes to interest. People don't realize that's what happens. And specifically, think about that wheel representing 7 years, right? You travel all the way around it. And what happens, I just told you, every 7 years, 98% of people do this process over again, right? So basically, 98% of people are constantly stuck on the front end of this wheel where the bank's getting all the credit, where you're making very little principal reduction. And people are constantly paying 40, 50, 60% interest, and they don't literally even have any idea they're doing it, because they're not taught through high school or college or banking, or even when you walk into the bank and ask questions, we don't commonly teach what an actual mortgage represents, right? And to be honest with you, the loan officer sitting at the front desk at the bank doesn't even know any different, right? Because they're given the products, they show you the options if you want to go. But if you walk into a bank and want to buy a house, they're going to show you an ARM and a 15 and a 20 and a 30-year mortgage, but all of those products are amortizing. I'd be very surprised if you walked into any institution that they threw out a simple interest loan at you, because it's not in the bank's favor to do that. Now, this is the amortization schedule of that exact loan. Everything I will show you is going to have math to back it up. You'll notice that month one, the monthly payment of $33.41, the interest portion is $23.33, the principal is $1,008. You'll see that the monthly payment's going to remain constant, right? Month one is the same as month 360 in a 30-year mortgage. It never changes. It remains exactly constant. But what does change is the interest and principal breakdown. Month one, the interest is $23.33, the principal is $1,008. Month two, the principal goes to $1,011, and then it gets better each month as the interest gets less each month, right? I'm not going to do this for 84 months, but if I did and I added these columns up, you would have paid the bank $287.20, $183 went to the bank, $97 went to your credit. That's just like visual proof in the pudding. You just literally paid 65% interest. Literally 65% of the money you gave the bank was classified as interest inside this 7-year window on this loan. Now, back to the three variables: interest rate, payoff term, and balance. Which one of these do you think has the most impact on how much interest a customer pays a bank? When I ask that question, the majority of people tell me rate or term, right? And most people tell me, people that say term, when I ask them why, they say, well, I don't really know. We all kind of know a 15 years better than a 30-year, but we're not even real sure the financial and fundamental reasons behind why that is. But that is correct, a 15 years better than a 30. But with focusing, most consumers actually answer this question by rate, right? Everyone knows when they're going to get a mortgage, everyone calls everybody they can to get their best rate. And then once they have the best rate established, what kind of term does most everybody put it on? Well, they choose 30 years, right? And why does somebody do that? Because it makes the monthly payment the least amount. Because remember, with a mortgage, your payment's due on the first of every month. It doesn't matter what's going on in your life. Doesn't matter what your work situation is, your family situation is, doesn't matter anything. That payment's due. If you don't make the payment, eventually you're going to lose the house. So people choose those long terms because it makes the monthly payment as little as possible, because there is no flexibility. Once you structure a long-term mortgage, the payment is what it is. The month one is the same as month 360. It never changes. Now, it takes you so long to affect your principal balance when you put any kind of rate on a 30-year mortgage, because of the amortization schedule I just showed you. Because the longer you stretch something, the more it's front-loaded with interest on the amortization structure. Now, I gave you a number I showed you that 4% was 65% interest, but 3%, even if your mortgage was 3%, it's still 52% interest in that first 7-year window. So people don't realize actually what they're signing up for when they're at the closing table. Because honestly, everyone has to initial the amortization schedule when you close a 30-year mortgage, but people just initial, because they're only paying attention to one column, and that's the first column of that schedule, which is the monthly payment. because if it fits in their budget, they're in. That's the way the American people buy things, right? And the guys that created the Federal Reserve and the mortgage were smart enough to know the monthly payment's what matters to them. So by doing it that way and amortizing, the bank ends up being the real winner on a long-term mortgage, without a doubt. Now, we call this first lien HELOC, we call it a smart loan. And the reason we do is because it's intelligent. For the right person, this is absolutely the way they should be borrowing money. And basically, we turn the triangle upside down. We focus exclusively on the principal balance. That's what this strategy is going to teach. And also with that, the payoff term is going to be shortened. And I'm going to show you that within reason, the interest rate doesn't even matter. What's so funny is the thing that everybody fixates on. The interest rate is the least important part of this equation, because time and balance are significantly more important than money. Time and balance are significantly more important than rate. The rate is by far the most irrelevant part of this equation. Now, it can't be 80%, but it doesn't really matter whether it's 3 or 8 or 10. Doesn't matter, because the rate's not the important part of this equation. And I'm going to show you that in a mathematical equation here in a minute. This strategy really isn't new. We're the only country in the world, to be honest with you, when someone opens up and does a long-term mortgage, the banks get incredibly wealthy. Nowhere else but the great USA is the amortization schedule structured like it is. It was actually done here prior to the US, and all these, they call these accounts different things in different areas of the world, but they're basically a simple interest account. You're only paying interest on what you actually have borrowed, versus a mortgage, you're paying interest on a preset amortization structure. Now, here's the strategy. Here's what's happened is we take your personal banking, which is like your checking and your savings. We take your cash accounts and we combine those with your home financing mechanism. And currently, for most everybody watching this, is going to be a mortgage. We're going to combine those into a singular account. And we call it a smart loan account, but in essence, what we're doing is we're creating an operating account for your household or your investment property. We're creating an operating account for it. Now, we establish a line of credit on your house, and in most cases, it can be 90% of the appraised value, and we go up to 90% on primaries, and we go up to 80% on investment homes and second homes. Now, the day we open this line of credit, we're also going to open our customer a checking account. Now, that checking account is no different than any other checking account any other bank has. You get checks, debit cards, mobile banking, internet bill pay, mobile check deposit. You get all the stuff, right? There is basically no difference. However, our checking account has an additional feature called a sweep account. Most people don't know what that is, and it does what it says. It sweeps, right? So let's say that you, as the person watching this, you bank at insert whatever bank name you want. I'm going to call it, B of A. If you have an account at BAA, if you flipped open your app on your phone and you looked at your balance in your account, your actual balance and your available balance in traditional banking are very similar, because whatever's in your account is what you have the ability to spend, unless you got something already pending to come in or out. Now, very different with an operating style account, right? So every day you log into our checking account, your checking account balance is going to be zero. Now, that's a very weird feeling, because nobody ever wants $0 in their checking account, because in traditional banking, if you have $0, it means you're broke. However, this is a simple interest loan where you're paying interest on the actual amount you have borrowed on a daily basis. So knowing that it's figured on a daily basis, the goal would be to have your balance as small as you can, as often as you can. And that's just going to lead to less interest being calculated and due by you, the consumer, at the end of the month. So our checking account automatically reduces itself to zero every day of the week, because it moves all the available cash to your line, making your balance smaller. And that automatically makes the amount that you have to pay smaller, because you owe less. Now, our available balance in our checking account is dramatically different than traditional banking. Remember, traditional banking is what you got there is what you can spend, right? Well, ours is what you got there is zero. But our available balance is not calculated on the checking account balance. It's calculated on the line of credit availability. So let's say you have a home that's worth $500,000 and you have a line of credit that's up to $400,000 on that home. And let's say you owe $250,000. That's the $250,000. That's where you woke up today. That was your scenario today. Even though there's $0 in your checking account, the available balance to spend in that checking account is $150,000. Because you have a $400,000 line of credit and you only owe $250,000. So there's $150,000 available to you. You could write a check for $150,000 and it'll just clear. Now, it's real money. When you spend it, you got to pay interest on it. You got to pay it back. But this provides a huge liquidity factor. What another huge advantage to the strategy is it provides liquidity to a fixed asset. See, real estate in most people's lives is their biggest asset. And if you want to get money out of the asset in the traditional banking world, you have to go borrow money. And when you do a mortgage, where does that start you out at? That puts you right back on month one of the amortization schedule, start you all over again. And who wins in the first part of that? Well, the bank does, right? So the bank constantly wants you to keep refinancing. And I'll just tell you this, like as a side note, it's not magical that banks reduce their rates every 7 years. You can look at mortgage rate historically, and it looks like a heartbeat. Every 7 years, they plummet. And let me tell you why. Is if you had a 30-year mortgage at 5%, 7 years from now, you're 7 years in, the bank calls you up and says, hey, we'd love for you to, we're grateful you're our customer, but we want to offer you a deal. We're going to refinance you at 4% instead of 5%. It feels good to you, right? Your interest rate goes down. Your cash flow goes up because your payment went down, right? Everything feels good to you. However, the bank in the first 7 years of a 4% mortgage is going to make more money from you than in year 8 through 14 at 5%, because they front load this with interest. So it's in the bank's best interest for customers to constantly be refinancing. And this product allows you to have, it's a 10-year draw period, right? You're allowed to take as much money in and out as you want for 10 years. And then basically people just renew their line every 10 years. But because once you're on this strategy, you're never going to want to go away from it. People that realize the strength of this strategy don't want to have the amortizing mortgage for any reason whatsoever. So I say our proof's in the math. So this customer's home value is $950,000, and I'm going down the right-hand side of your screen. That their 90% line of credit is $854,000. Their total household debt the day we enacted this strategy was $700,000. That means when we combined all their cash and all their debt into a single bucket, they were negative $700,000. So that means day one, they're available in their checking account. Their availability is $154,000 because their credit line was $854. They used $700 day one. This customer's household net monthly income is $25,000. Now, this represent what that number represents is that's the amount of money coming into your household. That's after taxes are paid, after 401ks and IRAs are invested. You know, we're not trying to teach people to go make more money or eat macaroni and cheese and hot dogs and pay their house off faster. What we're trying to show people is that for a certain group of people, percentage wise, there's a better way to borrow money than the way you're doing it. Because the next column says household monthly expenses of $14,000. Well, that looks like a pretty big gap, but it's because, if you'll notice in parentheses, excludes the house payment. See, with this strategy, you no longer actually have a house payment. As long as you service the debt and the interest on what you have globally borrowed through the operating account, that in essence becomes the house payment. And that's what creates the gap for people. So now I'm going to come up to the screen. I'm going to start at the left-hand side of the boxes. I'm going to start the current balance at $700,000. Now I'm going to start the interest rate at 6.5%. Now, those of you that are watching this say, oh, my interest rate's 2.75. No way would I trade 2.75 for 6.5. Well, I'll make you a challenge. You can do this math yourself. Pull out your current mortgage statement, and I want you to look at your current monthly expenses. I want you to look at how much is interest and how much is principal. And I want you to add those two together, and that tells you what your principal and interest payment is. And then I want you to divide that into the amount that's interest. And that's going to tell you what your effective rate of interest this month. And it's going to blow your mind that if you guys are in the first, 3 to 4 years, even in a mortgage that's less than 3%, you're still paying 40 to 50% interest. Where this is a simple interest loan, the amount is 6.5% period. There is no amortization schedule. So those of you that are watching this discounting, oh, I've got a cheap rate, I'm never refinancing. I would challenge you to let math do the decision making, right? Just we can punch a calculator in. We've got a specialized calculator built. We can punch your personal scenario in, which is what this calculator you're looking at looks like, and that's going to spit out the answer for us. So our rate is variable. And when I say that, most every customer thinks the rate's only going to go up. This is not that kind of rate. This is based off of the 6-month treasury. Very unique, right? Normally you hear on HELOCs or other loans, you hear prime plus 1, prime minus 1, whatever. Our index, our product is based off the 6-month treasury. And why do we use the 6-month treasury versus prime? Well, the 6-month treasury is a short-term index. Short-term index historically are much less volatile than long-term indexes, right? So basically you have a margin on top of the 6-month treasury that becomes your interest rate. But just because everybody thinks it only goes up, I'm going to increase the rate change per year at 0.5%. Our rates do not go up 0.5% every single year. This is for educational purposes only. I'm going to show you that even though the rate in this scenario skyrockets, the customer still pays off the house incredibly fast. The $25,000 is the money coming in, and the $14,000 is the money going out. This customer completely pays off this house in 82 months with this scenario, doing nothing different than what they're doing. This is their current income and expense plateau, right? This is their current family budget. So if you'll notice, we start with a balance of $700,000. Month one, income coming in. That's not the payment that's due. That's your income coming in that you're earning, whether it's W-2, self-employed, however. That's your money coming into the household. The interest at 6.5% on $700,000 for 30 days is $3,868. That would be an expense going out once a month. And that expense is out of $14,000. That represents gas, food, fun, life, vacation, clothes, golf, beer, cigarettes, kids, travel. That's your household budget going out. But you don't have a house payment anymore. That's why it becomes so low. So this customer's balance at the end of the first month is basically $693,000, because the income they brought in of $25,000 was basically $7,000 more than the interest and expenses going out the door. This just begins to rinse and repeat. Month two, income comes in, interest goes out, expenses go out, you have a new balance. And you'll notice every single month our interest is falling, right? Just like the regular mortgage does. The only reason that's happening is because the balance is being pushed down. Now, if you have a simple interest loan and you never change your balance, your interest payment is going to be exactly the same repeating unless you have an interest rate change. But let's assume this drops for the first 12 months. Now look at month 13. Month 13, the interest goes up. And the only reason it's going up is because my calculator for this scenario, and again, hypothetical only, it doesn't automatically go up, but I'm going to change the interest rate to 7% for the next full year. And we operate year 2 on 7%. And we get to month 25, my calculator, again, hypothetical, is going to change the rate to 7.5%. We get to month 37, my calculator is going to make the interest rate now 8%. At month 49, it's going to make the interest rate 8.5%. At month 61, I'm at 9%. And at month 73, I'm charging 9.5% interest. And if you'll notice, the balance on the right is still plummeting because of the cash flow positivity. We actually never even make to the 10% mark, because in this scenario you looked at, interest always went up. Well, that's not really real. And that's in that calculation to prove to you that the interest rate doesn't matter. It's not an important part of the equation. I also assumed income never increased. You'll look, the amount of money I have coming in the door month 80 is the same as you started with, day one. And then also expenses never decreased, right? Well, never a month ever you can spend less than you normally do. Now, I will tell you this, the cost of goods go up, gas, milk, et cetera, goes up every year. But the amount of income increase that the people, the clientele this strategy works for, their rate of income increase normally offsets inflation increase. The people that struggle with keeping up with inflations are very low income earners. And very low income earners, that this strategy isn't very effective for minimum wage people because they don't have enough cash flow positivity to push the balance down to make the strategy work. But so you're honestly looking at a worst case scenario. Nothing changed with this customer, just basically a different borrowing mechanism. And they were literally able to pay their entire home and their entire debt servicing off in 81 months because they were using a simple interest loan in lieu of the amortizing loan, which they're currently doing. The traditional mortgage, you would pay $503,000 on that $700,000 over the 30 years. And that assumes that you never, ever refinance it. That assumes that you start and you make the 360th payment. The scenario I just showed you, even though interest went almost all the way to 10%, you only paid $124. So this customer would save $378,000. Now, I'll tell you that that's actually the small number, because the gap in between these two houses represents 23 years. The deal on the left took 30. If you never refinance, takes 30. The scenario on the right using the smart loan or the first lien HELOC took less than 7. So now this customer has 23 years to fully invest their house payment into a compounding account. So imagine how much money it's going to grow to when you invest your full house payment for 23 straight years. It's going to turn into a big number. The benefits, most of the time, consumers, when this mathematically works for you, people pay off their house in about a third of the time or less, really doing nothing different than what they're doing, just using a different banking mechanism and a different borrowing mechanism. And you pay dramatically less interest for sure. But the last two benefits are the really big benefits with this strategy. In case of an emergency, or you get sick, or go on strike, lose your job, get hurt, whatever. COVID is a perfect example of this strategy. Let me sneak back up here and let's assume month 30 is the month that COVID reared its head. And let's assume that you made $0 for 12 months. You had no money coming in for an entire year, all the way through month 30 through 42, not any dollars come in, right? So because you have equity in the property, right? Your line of credit for this customer was $854. They have $470,000 of available credit when COVID hits. So even though there's $0 coming in for a whole year, there's still equity to handle the interest, and they can still do their gas, food, fun, and life like normal. They don't have to reduce it. Because with this strategy, as long as you know in the big scheme of things, the money's going to return, you don't have to panic. So self-employed people, seasonal people, commission people, variable income people, this strategy works incredibly well for them. Because if you're one of those individuals and you have 3 or 4 bad months and your cash reserves begin to get depleted, anxiety sets in because you're running broke. Because when you're operating in traditional banking, when your actual balance goes down, you're running out of money. But with this strategy, because you have constant access to the real estate equity, it allows you to self-sustain yourself through that income dip. And as long as you know the money's going to return, all it does is slow that down. Because let's assume month 42, a whole year later, it comes back, and things go back to normal, life goes on. Well, in that scenario, when I get to 81 months, that's not paid in full. That 12 months of income has to come in. So now we're at 93 months, and you are going to build up 5 or 6 months worth of interest during the time you were putting no money in. So even though you made $0 in a whole year, your payoff's still 99, 100 months versus losing everything you own, because most people can't go an entire year and not make a penny. It's not an option for them. So this strategy gives you access to the real estate equity to self-sustain yourself through an income dip. And the last benefit is carpe diem, access to cash is king. And it just provides an incredible benefit because real estate investors love this product. But this product provides liquidity to your non-liquid biggest asset. Because like I said earlier, real estate is people's biggest asset, and it's not liquid. And to get access to the money, you got to borrow it again. And when you borrow it again, you're playing right into the bank's favor because they're starting you at month 1 on a 30-year mortgage, which is exactly where you do not want to be. So in essence, that's the strategy. That's how it works. That's how it fundamentally happens. That's everything about it, right? So I guess at this point, Logan, that's it. That's kind of the strategy and how everything works. What questions do you have?
Yeah, that was a great presentation. If you want to stop sharing your screen.